I think GPs obviously feel the need to increase the DPI, and so they're doing that through continuation vehicle transactions now more than ever. And as they're thinking about fundraising, fundraising is as hard as it's ever been, given that LPs are over allocated, largely, and they're waiting for distributions to come back before they can start an allocation pace that looks similar to what it did in the past. And so really helps the story on the fundraising trail as well.
Hello and welcome to Liquid Courage. I'm David Snow, your host. Let's take a deep dive into the secondaries opportunity. Today, we're joined by Andy Nick, Managing Director and Co-Head of the Secondary Capital Advisory Business at Piper Sandler, Ben Perl, Managing Director and Global Co-Head of NB Secondary Private Equity at Neuberger Berman, and Joncarlo Mark, founder of Upwelling Capital. Gentlemen, welcome to Liquid Courage today. Great to see you all.
Good to be here.
We're going to talk about something very interesting. Most of us know what continuation vehicles are. They are a very important part of the secondaries market and a very important tool for providing liquidity to the global private capital asset classes. But we're going to be looking at the smaller end of the CV market because there's a lot of interesting dynamics down there that are different than perhaps the dynamics in the largest part of the continuation vehicle market. Why don't we start with a question for Andy Nick from Piper Sandler. Let's set the stage. The first half of 2025 set a record for secondaries volume, and GP-led continuation vehicles were fully half of that volume. What is generally behind the surge in these CVs going on in the private capital markets?
So you're right. It was a record year for first half volume. We saw 102 billion of total estimated global secondary volume, with the GP-led portion of the market being about 46 billion, or about 45% of that total, which was 50% year-over-year growth. And I think there's a few things that are really driving that. It's still been difficult for a number of sectors to exit businesses via regular way M&A or via public market exit. And so CVs have really allowed for distributions to be made in an environment where otherwise the distributions, have been very low. I think GPs obviously feel the need to increase the DPI, and so they're doing that through continuation vehicle transactions now more than ever. And as they're thinking about fundraising, fundraising is as hard as it's ever been, given that LPs are over allocated, largely, and they're waiting for distributions to come back before they can start an allocation pace that looks similar to what it did in the past. And so, really helps the story on the fundraising trail as well.
The exit environment is definitely a catalyst for GP-led, but from our standpoint, we think it's actually also part of a long-term secular trend. The basic business model of private equity is a bit imperfect, right? A GP goes out there, they identify a good business, they make changes, they improve it, and then they're sort of often on this situation where they're selling some of their best assets too soon structurally, and in some ways, what they're holding on to for longer are the underperformers. And GP-led is sort of turning that on its head, where a sponsor has done a good job, who feels a need to monetize, to create DPI, to lock in returns and de-risk for their fund, can sort of have their cake and eat it too. They can put that win on the board, they can create that liquidity event for their LPs, but they can do so while owning their best asset for longer. And that is secular, not just temporal in nature.
We're talking about smaller CVs, smaller continuation vehicles. I guess we would define small as maybe smaller than 300 million. We can see a breakdown of continuation vehicles done by size. A pretty big chunk is under 300 million. But what is different down in the smaller end of the CV market?
Yeah, the fact of the matter is there's been a consolidation in the market from a capital raising standpoint. And effectively, the big are getting bigger. So just the sheer number of managers in the smaller end of the market so significantly outweighs the number of managers in the bigger end of the market, even though the bigger managers on a proportional basis have raised more capital than the smaller managers. Creates the opportunity, the need for managers to be creative in the smaller end of the market and particularly take advantage of the secondary market. The other key element to the smaller end of the market is that there is more opportunities for these companies to do roll-ups and use the capital for growth that larger companies may just simply don't have those given the size and scale that they're already at. And the second positive part about the smaller end of the market and smaller CVs is that those companies have more exit options. They can be sold up market to financial buyers. They can be sold to strategics. And in certain cases, if they can grow in a more significant manner, they ultimately could be IPO candidates. Whereas when you're dealing with bigger companies, there's much fewer exit routes and perhaps more reliance on a public exit.
I'll give you something that we see on the front line as a buyer. When we look at the competitive landscape of groups willing to interact, there are a lot of buyers out there that focus on the assets and re-underwrite everything bottoms up. But there's also a cohort of buyers that very much looks to the GP. And if you're a buyer who falls into that cohort where you're really looking at the GP, one of the challenges that some people run into is the managers are just less well known. Not saying worse, not saying anything pejorative, just saying that the reality is the number of groups that are invested with and no manager raises a $500 million or $1 billion fund is definitionally much smaller than the number of groups who know a $10 billion or a $20 or a $25 billion fund. And so as a buyer, sometimes we see a very funny dynamic where there's less people willing to engage on those transactions. And not because of the asset, not because of the manager, just they can't check the box that they know the group.
Yeah, one other thing I would add is a higher degree of execution certainty with some of the smaller CVs. So there are situations where somebody may like a company, they like the sponsor, it's $1 billion or $1.5 billion CV raise, and ultimately they think, look, we like this, but we do wonder where's the rest of the capital going to come from? And when you're playing in the smaller part of the market, you need just fewer participants around the table to get the deal done. And in a lot of cases, the folks that have medium and larger size secondary funds for GP-led transactions, they can speak for 100% of the capital in one of these down market CVs. And so that just de-risks the overall transaction, which makes their bid look better for the GP from the GP standpoint, but also gives them greater certainty that there will be a transaction and all the work that they've put into it wasn't for naught.
Is there a higher bar for quality of assets to be put into these continuation vehicles among smaller private capital firms just because they have to sort of wow the investors with the quality of the assets because they don't have the name brand?
Yeah, no question that the bar is higher. So there are more opportunities for CVs or more available, but also it's harder to do. So those companies need to be better. Whereas in the larger end of the market, I think a lot of investors put perhaps a bit more weighting on the manager name and the brand versus the deep dive into the underlying assets. It goes back to what's the use of capital, and what the secondary investors want to see is capital being raised through continuation vehicles aren't just providing liquidity to the investors, but the capital is being used to continue to grow the business and generate the kind of private equity returns that they're anticipating. So, for instance, if these businesses are family owned, a private equity firm may own a minority position in the company, and capital being used through CVs may be used to consolidate that ownership and buy out some or all of that family or other shareholders in the business. So those businesses also may have been limited due to the overall desire for the family to take more risk in different strategic manners. So they act more like a cash cow, whereas the sponsors coming in who would then seek private equity type returns will have the ability to be more creative and do things the families would have not considered given their lack of risk tolerance.
Is it the case that, especially at the lower end of the market, a continuation vehicle might be larger for a single asset fund than they would be able to get for a regular way, blind pool limited partnership, because the asset is known, because perhaps it's a trophy asset and therefore more able to attract capital?
Yeah, we've definitely seen that situation play out multiple times in a single asset CV, where the actual continuation fund was, in certain cases, 50% larger than the flagship fund that it came out of. I think this is obviously a phenomenon that you will see more in the lower middle market than you would see in the mega funds, just because law of large numbers comes into play. And obviously, companies can only get so big and exit to a CV. So we've certainly seen that dynamic play out. I think the other point about buying out co-investors is very relevant here. And that has helped some of these where the performance has been great and it already would be a large CV become even larger because of those co-investor positions that the sponsor's been able to buy out via the CV.
I would add, wearing my, narrow-minded, selfish hat of a buyer, listening to him talk, it reminds me of one thing that we do see in a lot of middle market transactions, which is a terrific alignment of interest. Sometimes when you look up market, and we're not taking away from up market deals, there can be plenty of good up market deals, but sometimes when you look to the larger managers, it's sort of the icing on the cake, meaning, they have a $20 billion fund, they have $100 billion under management, and they're doing a $500 million or $1 billion or $2 billion CV. And it's not that you're misaligned, but it's very different than the dynamic that Andy quoted, where maybe you're partnering with the GP around an asset which is as big or bigger than their entire fund size. And so as a buyer, we love that dynamic, right? We sleep easy knowing that what that manager thinks of when they get in bed is that company. When they wake up in the morning, what do they think about? That company. And so as a buyer, sometimes that can be a terrific thing that you do see in the middle market.
Are middle market GPs, lower middle market, are they aware of the opportunities they have with CVs? Is this a well-known option for firms that are maybe facing some challenges with tail end fund positions?
I think for the managers we work with in the middle market and lower middle market, if they haven't done a continuation vehicle, they're generally aware of the fact that a lot of their peers are. But I would say most of them typically have a view that a continuation vehicle is for one purpose or another. They either know that it's for the trophy assets and they're going to keep their winners. It's ones where they need, more time or more capital to really realize the full value, and they're thinking trophy asset. The other use case, I think, is they're thinking, okay, well, this only can be for an asset that the exit was tricky for otherwise. And so a CV is a fallback option to IPO or a regular way sale to a financial or strategic. I don't think that a lot of mid-market GPs who haven't done a transaction realize that you could really do either path, or there's everything in between. There's multi-assets and they're only thinking single.
Another important consideration when talking about the lower end of the market is the independent sponsor segment, which didn't exist 20 years ago. They also would like liquidity. So to be able to raise capital for independent sponsors through continuation vehicles, the same need, give them an opportunity to have an off-ramp or stay in those companies, allow that capital to be productively used to grow the businesses, whether through acquisition, shareholder consolidation, or simply investing in new growth initiatives internally in the businesses.
Ben, from Neuberger Berman, what are the challenges that you think that GPs in the middle market and lower middle market face as they're kind of putting these together? What kind of questions do they have?
There's an extraordinarily high failure rate. Probably close to half the deals brought to market didn't get done. Some of that is a lack of capital, both actual capital and human capital. Part of that is some deals shouldn't have been done to begin with. And part of that is just not having the right setup, not having the right price expectations, the right terms. I do think, having the right advisors is incredibly important in this market. I'm sure Andy and Joncarlo, if it wasn't being recorded, would share countless stories of helping counsel their client in the right direction and getting them out of their own way. And so I do think, when we look at this market, we sit there and say it's not like staying at a Holiday Inn Express. You need to go in there. You need to have the right thesis. You need to have the right value. You need to be doing right by your existing LPs. There's a lot of things that need to come together.
Yeah, I would say we probably get the most questions about alignment, and we really think of alignment in two ways. The first is really the investor's alignment with the sponsor, and then the next is really the sponsor and the investor's alignment with the management team. We see sponsors, asking what is standard for us to be able to potentially take off the table. So they're used to, obviously, in a regular way, M&A, crystallizing and then realizing that carried interest, the GP commitment, the gain on the GP commitment. Typically in these single asset CVs in particular, or even the multi-assets, you're seeing buyers generally require 100% roll with minimal exceptions. There often is a conversation with the management teams in terms of that alignment about, we've been at this for 5 years. You told us you were going to exit to another sponsor or strategic. If you do this continuation fund, what does that look like? And so for sponsors that have a great relationship with the management team, where the board dynamic's good, I think it's a great way to extend what that successful partnership has become. But the management teams, are in a different spot than the sponsor in terms of the go forward expectations. And so economically, we see buyers typically wanting the management teams to be treated similar to how they would be in the sale to another sponsor. And so I think once management teams understand that, and once sponsors get on board with the first level of alignment really being between the sponsor and the investor, I think you'll have a lot better chance of getting these deals done.
think what people don't realize is that there's multiple stakeholders in these continuation vehicles. Of course, there's the GP who is effectively writing their best businesses, rolling their economics, and hoping that that company can double or triple in value. But you also have to consider management teams that may have been in businesses for 5 years. They too are seeking some liquidity. There may be a need to provide liquidity to the broader management team that have been hanging in there, perhaps earning less from a salary standpoint. So a continuation vehicle allows the realignment of interest, not just with the GPs, but also with the management teams who should be focused on doubling or tripling the business from a value standpoint, no different than the sponsors are.
What do you do in cases where there is a desire on the part of the GPs to bundle, let's say, weaker performing portfolio companies with the trophy asset? It's all at the tail end of a fund. They want to get liquidity, or rather there's LPs that want liquidity. Do you advise against packaging the weaker ones with the trophy asset? How do you get around that issue?
The mark to determine whether or not this is a successful transaction is whether or not we have any assets left at the end of it. Because if we have one stub asset and we have to keep the fund open and that requires an audit and all the tax reporting, that doesn't accomplish all of our objectives, then we need to find a way to get that done. I think if you look at the buyer universe now, it is so diverse that there's buyers who focus on single asset, only trophy assets. There's buyers who focus on single assets, Harrier situations. And there are buyers who focus on the more tail end portion of the market. And so I think the folks for which the tail end type of wind down transaction would be interesting, they understand that, there will be some cats and dogs often with one or two companies that they can really hang their hat on and get excited about the opportunity around.
Let's talk about valuation at the lower end of the market. It's a generalization, but is it harder to arrive at valuations for smaller companies? And is that sometimes a fraught point of negotiation in putting these CVs together? Maybe Joncarlo, since you've got a wry smile, we can start with you.
Yeah, so valuations is an interesting topic as it relates to the lower end of the market. And I think there's probably more variability down there. Generally speaking, I think smaller companies have lower valuations than larger companies. That's both the risk and the opportunity of investing in the lower middle market. If an investor can find good companies with reasonable, maybe lower valuations than they would upmarket, it creates quite the opportunity, particularly given down the road, if the companies perform, they can sell upmarket, achieve multiple expansion as either bolt-ons to existing sponsored back companies or strategic investors.
As a buyer, this is one of the real barriers to entry or challenges is there is no magical book that tells you what an asset's worth, right? And the range of values can be quite substantial, even though you may not think so. So I'll give you some made up numbers, but imagine a banker comes in and says, we think this business is going to be worth 10 to 12 times EBITDA. That doesn't sound like a wide range, but if the business has 6 turns of leverage, which isn't crazy, right? A lot of buyouts have at least 6 turns of leverage. That's a 50% swing in the equity value, right? There are 4 turns of debt if they're marking it at 10 times. If it sells for 12, that's a 50% premium. If it sells for 10 times, there's no premium. And if it sells for 9 times, that's a 25% loss. And so as a buyer, you really need to be right around your views around that company, that sponsor, their ability to create value, and that valuation.
Yeah, I'm still amazed after almost 20 years in the secondary market. I'm working on both the LP side and the GP side, the spread between the high bid and the low bid in any given process. And I think for a very well-known mega buyout fund on the LP side, the spread between high and low might be 10 percentage points. But for a middle market or lower middle market fund, that spread could be 30, 40 points certain times. I think the same thing applies in the GP side of the market. I think you're going to have more consensus. There's better public comps, for instance, around a business with 200-300 million of EBITDA. When you're talking about a buy and build strategy that started with 5 million of EBITDA and now is at 20 and may not have perfect comps, public or private, I think you get a wider dispersion in high bid and low bid. In and of itself, I don't know that that's problematic for the market because you're not selling to the low bid or even the average bid. And particularly on the small end of the market, when you only need 1 or 2 investors in a lot of cases, it's really that outlier bid that we're looking for. And we do a lot of things to try to drive value to try to get to that same level at or above where a sponsor would sell an asset to a third party, working with their industry bankers, really driving the story as to why the valuation that the sponsor has as a reserve price is reasonable.
What do GPs need to know about the treatment that their existing LPs get in these CV structures versus new money coming in? Do the existing LPs typically get any preferential rights in these things?
The gold or the platinum standard would be to let your LPs, if they don't want to take liquidity, maintain their existing exposure. So in that right, they would have a preferential right as it relates to their pro rata share of the transaction. They shouldn't be disenfranchised or forced out of their ownership unnecessarily. Similarly, we think the gold or platinum standard is let your LPs reinvest or roll over on status quo economic terms, meaning don't reset their management fee or carried interest.
Existing LPs obviously almost always have a reinvest or a roll option, and devil's in the details on exactly what they're offered and why. I think you can paint with a broad brush and say that a status quo option is always the best for an existing LP. But if you take a situation where an asset is done exceptionally well and the sponsor is well into the carry, they don't have to clear a preferred return hurdle before they're taking 20 cents of every dollar of incremental value that the sponsor creates in the existing fund. Then if you put that asset in a continuation fund and you give them a status quo roll option, they're ultimately going to be giving 20 cents of every dollar of gain to the GP from the first dollar of gain. If they reinvest on the same terms as the new investors, they may be in a better spot, right? Because the waterfall within the continuation vehicle likely has a preferred return and likely has a tiered carry. So before they're giving 20 cents of every dollar of gain, the sponsor has to have created meaningful value with the asset. So I think the facts and circumstances dictate whether or not the roll or reinvest option is status quo or not, or something in between. And I think that good advisors will advise sponsors to be as LP friendly as possible.
One of the important elements of the current market is just the bifurcation of fundraising. The larger funds are getting bigger. They're raising new capital into adjacent strategies. And the lower end of the market overall has received less of the overall capital available for new investments. So therefore, continuation vehicles make a lot of sense and provide a continuum of capital for smaller managers who may not be able to go out and raise $500 million of commingled capital, but certainly can raise a few $100 million for specific single asset or multi-asset CVs. And in fact, some of the data out there suggests that many of these CVs are at least half, if not the same size as their previous commingled funds that they raised, which makes sense. They're putting their eggs into the best performing businesses that they own. And they're saying, look, if we've taken this business from 20 million of EBITDA to 50 million of EBITDA, we think that we can take it to 100 or 150 million. Obviously, those transactions are going to be bigger, but it does provide them the ability to raise capital in a tough fundraising market when they can't necessarily access the traditional capital for blind pool funds.
How can a GP group be very strategic in thinking about using these continuation vehicles as a bit of a bridge to the next fundraise? They've got perhaps a trophy asset. The fundraising market's a little challenging for, let's call it, lower middle market private equity firms to raise the next regular way blind pool fund. But is there anything that's kind of strategically smart that a GP could do in thinking about managing LP relationships, whether new or existing, leading to that next regular fundraise?
Yeah, absolutely. As we think about putting together a buyer list for a single asset CV process, for instance, we're putting together a long list of investors, and then we're really tiering that, and we're introducing the transaction to various groups of investors at different times. For instance, you have a long list of folks that could be syndicate investors, but going to them the day you launch the transaction when you don't know valuation, terms, identity of the lead investor, they're going to say, this sounds interesting, but I need to know more before I really spend time and dig in. So we'll go to the tier 1, tier 2 investors first. And I think sponsor has a fiduciary duty, obviously, to make sure that they're doing right by their existing LPs. And so we're trying to find the lead investor really without regard to, is that a pure secondary fund? Is that a family office? Is that a fund of funds? We're trying to find who's willing to give the best price for the assets.
We know that investors in continuation vehicles are, of course, very interested in the assets themselves, the companies themselves in the CV, whether it's a single asset or a group of them. But to what extent are they going to perform due diligence on the GP group and the dynamics among the GPs who are proposing themselves as the managers of that asset going forward? What do GPs need to understand about the kind of due diligence and kind of questions they're going to get as the managers of the CV?
Look, I think you hit the nail on the head. Investing in this asset class isn't easy, right? First, it does start and stop with the asset. If you invest in a business that's earnings are not going to grow, you're going to be challenged, right? So first, invest in good assets. Number two, investing in good assets doesn't always make a good investment, right? You can't divorce the asset from the return. So you also need to look at what's my entry valuation. And if you invest in good assets at good values, that's also still not enough because you do need to analyze the person steering the ship. And, I'll give you a great case in point. One of the challenges sometimes with lower, in particular, very small end of the market is the skills get different as the companies get bigger, right? So you may have a manager that did a good job. They bought a platform, I'm making it up, but $3 million at EBITDA for 7 times. And they did another $10 million at EBITDA, and now they're packaging it up at 9 or 10 times. Well, the skill that it's going to require at the next level to integrate those businesses, to do M&A on a different scale, to recruit the management teams, to think about who will be the buyer, how will it fit within that buyer's thesis, if it's a strategic, if it's a private equity firm, that is different. And so, we do look at the sponsor and say, are they capable in the next leg of ownership? And what drove their success early on? Is that likely to continue? Or is it a different set of skills and a different playbook? And I would say that's a common reason for us that we might not get there on a transaction.
Yeah, the GP quality is absolutely something that every buyer in this market, every syndicate investor, every lead investor is looking at. I would say there are folks who put the sponsor quality first, and it could be the best asset that they've ever seen. But if the sponsor doesn't check certain boxes, if it's not a sponsor they've invested with on a primary basis, they may just say no to the opportunity. Others will put it lower and they will look at the asset first, and then the sponsor has to be of a certain quality in order for them to proceed. But it does differ between the various buyers as to whether or not I would say they're more asset forward or sponsor forward in terms of the initial focus of their diligence.
Is it ever the case that a new investor that is brought in to be a partner or to invest in the continuation vehicle is brought in on a strategic basis? Maybe they have some sort of operational capability, or maybe they have some sort of network that would be beneficial to the portfolio company.
Absolutely. And I'd say that's even more prevalent in the lower middle market. I worked on a transaction not long ago where the lead investor ultimately was given a board seat, which is not always common in these transactions. The sponsor was more than happy to do it because they felt like they actually would put somebody on the board that could add a lot of value, as that sponsor did look to make that transition from this being a company that went from just a couple $1 million of EBITDA as the initial platform, but had scaled through acquisitions. Was doing a good job of integrating what they knew to take it to the next level. And it was going to look a little bit different than a lot of their portfolio companies had to date. So I do think that that is something that a lot of the new entrants in particular are trying to bring to the table as they look to break into the market.
Lower middle market opportunities may be deficient strategic leadership or other valuable characteristics that sponsors bring to the table. If you're talking about a big company, they're well developed, they've got broad management teams, it's easier for them to recruit talent. The lower end of the market, not only can an investor bring capital to the table, and even through a CV, they can bring introductions to other companies within their portfolio or help augment the sponsor with introductions to potential members of the management team. So all of that goes to the ability of creating real value in smaller companies, whether it's a direct investment or through a continuation vehicle. So one of the trends that you've seen are several name brand private equity firms, perhaps large or even mega managers, have raised continuation vehicles to invest exclusively in CVs. And the idea is that those managers can bring a level of expertise that they bring to their larger portfolio companies. And even through a sponsorship or investment through continuation vehicles, can augment the performance of those companies with those relationships.
Are there any sort of deal breaker terms that perhaps some GPs think they can ask for, but they're just not going to get it?
I often see a push and pull between management fee and carry, and I think most buyers would prefer to be aligned with the GP to maximize exit value and therefore put more of their incentives into the carry. So I think for a sponsor who, is looking at it as a free option, it's a tough road to hoe to get buyers interested. For instance, if their ask on the management fee is just something that is off market.
In this market, it's typically table stakes to roll over all of your exposure. And, honestly, we see beyond rolling over all the exposures in general, GPs actually trying to upsize. In fact, Andy and I are hopefully in the process of closing a deal now, and the GP is trying to borrow additional money to invest into the company. That's the level of conviction that they have in it. And so as a buyer, I would say, if you have a sponsor sitting there saying, look, I'd like you to staple money to my next primary fund. I want a high management fee and I want to de-risk and take chips off the table. In totality, that gets pretty quick to pass on. But any, individual term in isolation is rarely a true deal breaker.
Great. Final question for the three of you, and we can make this a little bit of a feel-good question, but basically talk about something that makes you excited to be part of the secondaries continuation vehicle market going forward.
When I entered the secondary market almost 20 years ago, it wasn't the type of thing that I ever thought would make the front page of the Wall Street Journal. And I would say that, our industry has really come of age, and it's an exciting time to be a secondary advisory professional. Almost every sponsor that we speak with, if they haven't done a CV transaction, they're considering one for one of the different flavors of CVs, if you will. And so it's exciting, I think, to be, really relevant to almost every client of Piper Sandler and really just, be able to provide the full services of the bank to these clients.
It's really no different than what we've experienced over many, many years. And I would say it starts and stops with the people. We get to work with some pretty incredible sponsors out there, incredible talents, incredible human beings who've, had a tremendous amount of success in the industry. And we get to form a very close personal relationship with them. We get to partner with them on some of their highest conviction investments in transactions that are incredibly important to their franchise, as you've heard here today. And hopefully, if we do that right and we invest with some incredible people and some incredible assets, our investors will ultimately reap the benefit of that.
The secondary market has evolved so much over the last 15, 20 years, and has really accelerated really over the last 10 years with the introduction of continuation vehicles and other structured transactions. And it makes sense, right? The amount of capital on a relative basis of private capital that's going into the market is so much higher today than it was 20, 25 years ago. Clearly, finding new technology in the form of liquidity is important for investors who have much more weighting to private investments, which by their nature are illiquid. So it's neat to see how continuation vehicles give optionality to institutional investors who may need liquidity because they're not getting it elsewhere in their portfolio. If they want to stay in, if they want to rebalance, they can stay in, sell out, and much better manage the liquidity than simply waiting for an exit, which in a market that has generally lacked M&A, they can supplement by participating in continuation vehicles. So generally speaking, I think the secondary market is going to continue to evolve, particularly with the advent of more high net worth / retail money that comes to the table, and liquidity, interim liquidity will be needed. And the secondary market is definitely going to have to play a role in fulfilling that need.
Excellent. Well, Andy Nick from Piper Sandler, Ben Perl from Neuberger Berman, and Joncarlo from Upwelling Capital, thank you so much for joining a Liquid Courage episode. And I know that I'm going to have all of you back in the future, and it's going to be great.